Hi. Years ago, I ran the research department of Canada's premier institutional broker. I managed 17 analysts of all shapes, genders, and persuasions. But one thing unified them. Like all brokerage employees, they had the soul of agents. That is, they shied away from taking risks themselves. Rather, they preferred making a living by advising risk takers. To use an analogy of ancient combat, analysts are not fighters. Rather, they are lance carriers and map providers for knights who do take risks, that is, portfolio managers. How good were those analysts? In company knowledge, they were tops, but in stock picking, not very. Why? Because portfolio managers, knights of market combat, if you will, win when they take risks. Analysts usually shy away from taking risks. So soon it became clear to me that to help my analysts improve, I must teach them to embrace risk. But how? One day, my mining analyst, let's call him Alex, came to me with a strong sell of a premium mining stock. Why sell it, I asked. Because, said Alex, they are about to lose more than they had ever lost before in their history. I went over his spreadsheet. Yes, I said, you're right, but why sell? Why? Because they'll destroy their book value, they eat up their cash, and they cut the dividend. Okay, I said, bring me the stock chart. What? Said Alex. I thought you said you were never to use chart, just to do fundamental work and what do you call it, sleuthing? Yes, I said, but bring up the chart anyway. The chart went back 48 years. The company, as I said, was a premier long-term miner. And of course, its stock went up and down over the years with the economic cycle. Now, I said, show me where they lost the most money before. This year here, said the analyst, and here, and here, and here. And soon, now too, here. Right, I said. Now look at the stock price chart. Were these maximum losing years good times or bad times to buy the stock? Alex squinted, then raised his eyes, which had become large. What do you know, he said. It seems the best times to buy the stock was when they lost their shirt. Right, I said. And why was that? I don't know, he said. Why? Because the mine assets were the same, the engineers the same, the industrial clients the same, and the world the same practically. Only the world was in the dumps temporarily, and therefore so was the stock. But sooner or later, the world would totter back to normalcy, so would the company, and so would the stock. Oh, Alex said, but if I told the client to buy the stock because they lost money, they'd think I'm nuts. Not all, I said. The young clients might, but the old ones wouldn't. You sure? Try it, I said. I give her permission to show the chart and quote the fundamentals at each past losing year and compare them to today's. The following week, Alex was back. What do you know, he said. We just moved a huge block of the stock on a buy order by our oldest client. The trading desk loves me. So Alex added, should I always look for losing stocks? Not always, I said. But in cyclical ones, mostly yes. Now, why do I tell you this story today? For two reasons. First, to push you toward thinking like a principal, a risk taker, not like an agent, who is a risk avoider, an analyst. But second, to teach you one more way of how to look for multi-baggers, the kind of stocks that can rise a multiple times of their purchase price. How to do that? By waiting to buy good cyclical companies when the economy is in the dumps, so that the cyclical stock price is in the dumps too, selling for a fraction of a bag before it becomes a multi-bagger at the peak of the cycle. Like when is the peak of the cycle? Like now, almost, which is very close to peak. In other words, buy them at the bottom when things look terrible, when no one wants them. Like when? Like March 2020, when COVID hits. Remember that? And sell them when? Like over the next quarter or two. Maybe three, but maybe not. When the Fed prints crazily to save the economy. Only the next printing is likely not to keep the economy flying. In my opinion, it's only an opinion, sometime next year, in 2022, we are likely to have an economic debacle, worse than 2020. And if we do, there are going to be many stocks trading at prices a fraction of today's prices, perhaps even as low as they were in March 2020 at COVID bottom, maybe even lower. And if you are prepared for it and keep lots of dry cash, you can get them before they soar again, because soar again they will. And why will they soar? Because, just like in 2020, the Fed will panic again with the market, perhaps even worse than before, and print some more. Okay, now which stocks are the ones to keep you on your gun sight? Take your pick. Just look at stocks that crashed in 2020, then soared 6, 7, 8 times, some of them more, to where they are today. Usually these were luxury stocks or travel stocks or fancy brand name stocks that depend on luxury spending that evaporated as COVID tanked the economy. Now, which stocks, for example? Like diamond retailers or cruise ships or fancy consumer product stocks or heavy industrials even. When the market totally capitulated with the fear of greed index below 10, below 5, perhaps, as in March 2020, wait for these stocks to get to their previous low or lower and be ready to pounce. Now, which ones exactly? Here are 4 of them as an example only. A few weeks ago, I mentioned CX, Cement Mexico. They make cement. And a few other things. When the economy tumbles, so do they. But after the Fed prints and the economy goes up, up they go. Today, CX is mostly up. But when the economy and the market tumble again, it will again be down. How far down? From 6 today to maybe 2 to 3 in the future. But careful, it may even get below 2. Who knows? So get ready for a panicky hold period. But after the Fed prints, the stock will likely rise again. The second name is SIG, the jewelry stores. It had soared from 6 in 2020 to $80 plus today, or 12-bagger. If the economy crashed and burned next year, SIG may very well plunge below 10 again, maybe below 8, maybe below 6, maybe lower. It's possible. The problem is, as you begin to realize, you may buy it at 6, but it may then go down to 3 or 2, maybe even 1. Who knows? However, as before, once the Fed prints again, not if, but when, up it will most likely go. Or how about oil stocks? Oil today at around 70 may fall under 25, maybe under 20 as the economy craters. Even as big caps like Exxon, XOM, which stupidly stopped drilling due to unwise advice by some hedges. Exxon stock usually traded below one-time oil price for some reason, at the bottom, sometimes even at 50% of the oil price. So if oil falls to 25, you may see Exxon fall from 63 today to 20 or even below in economic debacle. By comparison, it fell to a low of 27 in 2020. Or how about cruise lines? For example, Royal Caribbean Cruise Lines, RCL. I had pointed it out nearly 2 years ago, from which point it more than tripled. How low did it fall in 2020? It fell to 27 in 2020. Today it is 76, or a 3-bagger. However, it fell much lower still in 2009 to 6. What price can RCL fall to if the economy crumbles? Who knows? But if you catch it close to the bottom and it again soars to 60 or 70, here is one more potential multi-bagger for you, which again will pay you with grief at the bottom as it goes up and down 50% before it starts soaring. How low can it fall? Another economic meltdown? Well, go sleuth it and make up your own mind. Anything else? Yes. Freeport-McMoRan, FCX, copper, resources, and more. A senior resource company as they can get. It fell to 5 in 2020. 2 years before, it fell to 4. It is now at 38 now, or a 7-bagger. If, when the economy craters once again, as I think it will, FCX too can go back to 4 or 5, but it may again rise multi-bagger to the 30s. Will it? Go sleuth it too and wait for it. But don't just make do with these 4 names. Go make a list of your own, of stocks that had run up multiples since their 2020 bottom, as well as their bottom prices then. If any of these stocks get close to the 2020 bottom next year, and the Fed panics, you might just buy them cheaply enough to give you a multi-bagger. You just might, not for sure. But remember, waiting is essential because the best sleuths are Boy and Girl Scouts. They are always prepared. Be prepared too. With again a caveat, very important one. None of the above mentions is a recommendation to sell short, not to buy at a noted low price. It only means they are only meant as an example of stocks that may be worth your while to sleuth if they ever reach these low prices, which they probably will. if and when the market finally tumbles. When? Patience, grasshopper. It will get there. Wait. That's all for today. Please let me know what you think of the idea of waiting patiently for multi-baggers, potential ones. And if you like the idea, give it a like and subscribe, and tell all your friends that they subscribe too. I'll see you next time. And meantime, thank you very much for watching.